Hello everyone, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. Excuse the hoarse voice. Our local high school team went to the finals of the state baseball tournament, and I yelled a little bit too much. So anyway, it's June 10th, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Folks, what we're going to do again here today is give you two reports. One is on the S&P 500 Condor Butterfly Timing report. And for those of you trading butters and condors, this is a great way to get a clue as to whether the market is likely to end up being favorable for you to do so or not. And so we're going to take a look at that, as well as the likely direction that the S&P 500 will take given its current market condition and how that condition has fared in the past. Okay, now remember, we'd love to have you subscribe to us. Just click the below button, and we'd love to have you become a subscriber. This is the video blog of Frank Fahey's text blog, available at discoveroptions.com. Click the blog link, and it'll take you to a fantastic report that Frank kicks out every weekend. Lots of volatility information, lots on the VXX, the VIX, as well as earnings. Lots of good earnings information as well. And he calls it the Prepared Mind because his father always told him, Frank, chance favors the prepared mind, by Louis Pasteur. Finally, before we get to the reports, I want to make sure you know you could get a free book, a free ebook. Just click on the link above in the upper right, and that'll take you to the place where you could download the Simple Steps to Options Trading Success by Jim Graham and myself. On to the reports. Here are the two reports, the Condor Butterfly Timing Report and the Directional Likelihood Report. Let's get to the Condors and Butters first. I'm going to show you the report, but first I'm going to show you really why we need to do this report, the methodology behind it, and then the current condition and the current edge level. Okay, so why do we do this? Well, folks, for those of you trading butters and condors, if you were back looking at the end of December 31st, the edge level on our report would have been about 4.2% on the negative side. On the negative side, meaning flashing that basically it was more likely that this was going to be an unfavorable bar than normal. More likely than usual, it would be an unfavorable bar. And sure enough, it ended up going down, as you can see there. What we're saying is that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. A negative edge means that there was a higher than usual likelihood at that time that the market was going to be more volatile than what was implied by the option prices. And sure enough, it ended up going down and was very volatile in that particular case. Now, the current market condition today looks like this. Okay, we've had two downswing days with a lower close on Friday, yet we're above the 50-day simple moving average, and the stochastics are very much in the overbought area, but beginning to come down underneath its moving average. That's a very unique market condition. In fact, if you go all the way back to January of 2000, this condition, as I define here, has occurred less than 100 times. Less than 100 times. So, is this condition, though, good for selling premium, butters and condors, etc.? So here's how we do it. Here's the methodology. We take a look at how much the market moves after each close. A 21-day move after each close. So let's take the, back at the end of April where that little red line ends. Let's look at the close right there at 2076. Now, in the course of the next 21 days, what was the maximum amount that the market moved? Well, it ended up going down 50 points. That's how much it moved, 50 points. And when you take that 50 points and crunch it out, you end up with a move of about 2.4%. And when you look at that red line where I'm graphing the move you could see indeed it's set up at 2.4%. Now here's the question. What was the market move that was being implied by the option prices at that time? At the end of April, on that date, where it closed at 2076, what was the VIX saying? More importantly, what was the skew adjusted VIX? Because there's an upside vol and a downside vol that the SIBO skew you can use to extrapolate that. Okay, just using the VIX in this case, without skew adjusting it. The VIX was implying a move of 4.4%, yet the market moved only 2.4%. So I think you would agree that as a Condor butterfly person, that day would have turned out to have been a favorable day for you to sell option premium. And in fact, whenever that blue line is above the red, we can go back and mark those bars blue. And in the cases where the actual line, the red, goes above the implied blue line, that's when we would have had what we call unfavorable bars for selling option premium through Condors and Butters. Okay, so that's where it's at in terms of favorable and unfavorable. That's a huge part of our methodology. So historically, moving along, what percentage of those bars are favorable? And then, of the bars that match our current market condition, what percentage of those were historically favorable for premium selling? So we have, all in all, the history in broad, in general, and then specific to just our market condition, what was the percentage of blue bars? If there's a difference there, well, that could represent a good edge. Okay, so let's look first. What percentage of the bars, all of them going back 4,100 or so, going back to January of 2000, what was the percentage that were favorable for selling premium? About 66.9% when you crunch the numbers here. Okay, roughly 2/3, 1/3. 2/3, 1/3. Now, of the bars that match our current market condition, what percentage of those were historically favorable for premium selling? As I told you, there's less than 100 situations like what we have today on Friday's close. Okay, this is a very unique current condition. Okay, as defined right there. And I did not even use average true range at all because it's a pretty fat bar on Friday. That would have lowered it to under 60 times that it's happened like that. 71.4% of the around 100 or so of the times that occurs like it did on Friday, that current condition. Okay, 71.4% of the bars are favorable. Now that represents roughly a 4.5% edge. Because remember, 2/3, 66.9 on the broad history are favorable, yet our current market condition results in 71.4% being favorable. So it would appear then that there's a slight edge to selling condors or trading butterflies right now. Okay, so now does it mean you're going to make money? No, not necessarily, because you got 30%, that'll end up being unfavorable, where the market's going to move a bit more than what was implied. But listen, I know I'm speaking to advanced traders. Okay, you know how to make adjustments. You have your own secret sauce in terms of how to adjust, and we do it at Discover Options. We can teach you how to do that if you want. Okay, but this is just a good little way to help you time your entries in Butters and Condors. Right now, it's a little bit, it's more likely than normal. Okay, that there's a higher than usual likelihood that the market will be less volatile than what was implied by the option prices. Okay, so, and that's the timing report that we come out with, and you can see it's at 4.5%. Okay, let's go to the next report. Before we do that, I want to make sure you know that at Discover Options, we have a series of one-on-one mentoring programs for you to consider. Covered calls, puts and collars. Okay, we have an equity track and a futures track that has 14 and 7 respectively sessions for you. It'll get you from A to Z It'll help you become really an expert options trader, not only giving you the book knowledge and the strategies, but you can spend 14 hours with our mentors getting acclimated to what it's like to be an expert options trader, selling premium, directional spreads, or option overlays, etc. If on your long stock holdings, etc. We have it all here. Okay, starting at just 99 bucks. So go to the website, check it out. We would love for you to be a student, even if you want to dip your toe in the water for one of those top classes there, just covered calls or puts, just to see what it's like. Okay, let's go to directional likelihood report. Current market condition, of course. And the question here is when you take our current market condition since January 2000, how often has this occurred? And I told you roughly 100. Less than, what was it? Let's go back. 85 times. 85 times it's occurred. And what direction did the market typically go out of those 85 times that this occurred? What happened? Did it typically go up, down, wobble in the middle? Let's go find out. Here's how we do it. We first have to understand the historical distribution of price. Then we understand the distribution after a specific condition develops. And if the two are different, well, there's an edge. How do we look at the distribution of price? Bullish, bearish, wobbling in the middle. Okay, we have to look at the distribution of price. Here's how we do it, folks. We measure by observing how often price touches one standard deviation volatility bands that are placed, I forgot the D there, from each bar's closing price. We use 3 volatility bands, 5, 10, and 15 day, measured a standard deviation from each close. We use a 20-day historical vol, and it's log normally distributed. Here's an example, real quick. We take a given close, we draw the band at the top, band at the bottom. This is one standard deviation set 10 days out. Question is the market going to go up and hit the top band, the bottom band, or wobble in the middle sometime over the next 10 days? Okay, let's go see. Boom, went up and hit that top band in short order. So here in our database, we're going to record that it hit the upper band. Now, look at the close up here. Question is, does it go up and hit the upper band, the lower band, or does it wobble in the middle over the next 10 days? Let's go take a look. Boom. It tried to go down and hit the bottom band, but close but no cigar. Take another look. There to there. So in this case, it hit neither. So in the instance of that close, we're going to record that price hit neither of the bands. Now from every close, we're going to record how often price struck the upper, lower 5, 10, and 15-day bands. I'm just showing you the 10s here. So in this way, folks, we're then recording and getting a good sense of the distribution of price randomly from history. And in this case, for the S&Ps, look at this. It hits the upper 5-period band, 5-day band, 29.5% of the time. The lower 10 and 15, roughly 23% of the time. Then it hits the lower 5 and 10, roughly 30% of the time, and the lower 15, roughly 32% of the time. That's out of over 4,100 signals. So that's the broad distribution. Now, if price is distributed differently after our scenario develops, well, then we might have something, right? I mean, if we find a market condition where the upper bands are getting hit 100% of the time, we would conclude that that market condition typically leads to bullish behavior. Does that make sense? Or if a certain market condition develops where all 3 of the lower bands are hit 100% of the time, we would conclude that that particular market condition is very predictive of bearish behavior. And then we want to go all in probably, or at least, ramp it up a little, right? So we're going to have to look at the distribution after our scenario develops and then measure the two against each other. So here's our condition. It's happened a couple times since the beginning of the year. That same condition that I just expressed. And what we do then is we record the distribution of price moving forward as of the close. We also look at the distribution if price goes above Friday's high. Also, if it goes below Friday's low. Okay, so let's just take a look. Here it is. As of the close on Friday, looking at all 85 signals. Okay, the upper five-day band gets hit 32.9% of the time. That's 3.5% more than what it does randomly over the course of history. It hits the upper 10-period band. Okay, 25.9, which is higher than history. Upper 15-day band, 30.6% versus 22.9. Look at that, 7.7% more. So it's hitting these upper bands more often, all right, than what historically they get hit. So we would conclude that the pattern we have now is slightly bullish. And in fact, look at this, it hits the lower bands less often than historically the bands get hit randomly. And that's why we have the negatives here. So this is a very much of a bullish expectation. Market's been trending up. Now it's pulled back a few days. And when you look at historically what's happened, now does that mean that it's going to go up? No. It means that there's a slight bias towards it when you look at historically what this pattern has generated. Okay, does it mean it's not going to go down and hit these lower? Well, no. All we're doing is taking statistics and showing you whether there's an expected edge or not. Okay, so we can't guarantee anything, but we can at least look at the statistics and make some conclusions. Now, what if price exceeds Friday's high? That'd be a long way in this case. If it goes above Friday's high, we're getting a mixed bag. Now, the upper 5 is hit way less often. The upper 10 a bit less often. And the upper 15 is hit pretty darn close to the same, just 2.2% more. Okay, so if it goes above Friday's high, okay, I think there's more of an expectation that you will see less volatility in general, where 4 out of these 6 bands are getting hit less often if it goes above Friday's high. What if it goes below Friday's low? Okay, if it goes below the low, I think we can see that there's an expectation. Well, these aren't very much different from the historical number. The upper one would get hit 4% more. 27% were hit on the upside. And it's pretty much a scratch. Well, but again, it's kind of like it's kind of a mixed bag in a sense. Okay? There were also some inside bars because when you add these two up, they do not add up to 85. So some of those 85 resulted in inside days of just following it. It neither went above the low or the above the high. Okay, so all in all, we take a look at the close. Bullish expectation. If it goes above the high, okay, not so much. If it goes below the low, that's when more of the bullish expectation can kick in here. Okay, now what we like to do also is do the bands a little bit different, where we use the VIX instead of statistical volatility. VIX is usually higher. It's higher than statistical, so the bands are farther away and they don't get hit as often, as you can see here. And when we are using more bands that are reflective of the VIX, they're not getting hit as often, and indeed at the close they're getting hit way less often across the board there. You see that? Okay, look at this. if it goes above Friday's high, significantly getting hit less often on the upside, little bit tiny more so on the downside. And then on the if it goes below the low, much less volatility, of course, if it goes below the low. Now, one thing I like to do is, in this case, let's just say that you're bullish and you want to consider using a bull put spread in the S&Ps. I took the VIX, carved it up into the expected upside volatility and downside. Downside ends up being at 19.9. And what we're going to do is use that number to then take a look at doing a bull put spread in the S&Ps. Okay, and what we do is, I'm just showing you here that we take the VIX, we carve it up into a downside expected volatility and an upside volatility. Instead of just taking the VIX, because in the options you have that vertical skew, remember, and there's a difference between the downside vol and the upside vol. Let's take this 19.9 and apply it, okay? Go to the option view. We plug in 19.9 up here. In the July 15th expiration, that takes us all the way down to the 1970 as our short strike. And when we do a bull put spread way down there and analyze it, you could see that we would make 10% as long as the market as long as these options expired with the market above 1970. It's about 125 points further down, even after, well, let's see, 125? Yeah, 125 points. So even though the market's come down quite a bit already, you'd have to go down another 125 over the next month for it to hit that short strike. Now, if it does it, and you want to get out when it hits that, you can expect to lose around 28% or make 10%. Now let's go back up and see the statistics as to how often that 1970 has been hit in the past, okay? So we come up here. And that would be, see, we're not going out a full month, are we? We're just going out 15 bars. It's about 3 weeks. Let's go back here. Steve, wait a minute. Here. Oh, let me do this. Click. Click. 3 weeks takes us to, yeah, here. Well, 3 weeks out, what you'll see, oh, come on, here we go. Boom, there we go. Click. Click. There we go. Takes us out to at least at the 3 week mark. That number is getting hit on the lower 15-day is getting hit, well, let's see, 11.8% of the time as of the close out of 85. Okay, not too bad there. So when you run the numbers, if you lose 28 once and then you make 10 the other 9, you have a pretty good edge, right? So that's kind of how we like to do this statistically, is take a look at it that way. But there you have it, the butterfly condor directional and the likelihood of the directional move. Okay, folks, thanks a lot. We will see you next week, same bat time, same bat channel, right here at the Prepared Mind video. Thank you. Bye-bye.